Your money is being diluted right now, and the entity doing it isn't a foreign power or a shadowy cabal. It's the United States government, feeding an addiction it can no longer control. America has become both the dealer and the addict in the most dangerous financial dependency in history. The drug? Its own debt. And like any addiction, the doses keep getting larger while the side effects become impossible to hide. What you're about to discover isn't taught in economics classes, because it reveals a truth too uncomfortable for those in power. Your nation is trapped in a self-destructive cycle that requires constant debt infusions just to maintain basic function. Here's what most people don't understand about government debt. When Washington spends beyond its tax revenue, it doesn't just write IOUs, it creates financial instruments called Treasury securities that have historically been considered the safest investment on Earth. For 2 centuries, global investors, foreign governments, and financial institutions craved these securities like a stable commodity. Why? Because America always paid its obligations. This track record built unshakable trust, and that trust became leverage. The government discovered something intoxicating. It could run deficits indefinitely, as long as someone kept buying. The promise embedded in each Treasury bond wasn't just a commitment to repay. It was the fuel that powered everything from military operations to social programs. But here's where the story gets dangerous. America didn't just discover it could borrow freely. It discovered it could supply its own demand. The addiction didn't start yesterday. After independence, the young nation faced crushing war debts that threatened its survival. Alexander Hamilton made a fateful decision: honor every obligation completely, establishing federal creditworthiness as sacred. It worked brilliantly. Each successful borrowing round reinforced a dangerous pattern. Debt works if you maintain appearances. This precedent echoed through generations. When the Federal Reserve was created in 1913, most viewed it as a banking stabilizer. But it did something more insidious. It gave the government a partner in enabling its growing dependency on borrowed money. Then came World War II, the moment that normalized massive deficit spending as not just acceptable but patriotic. The psychological barriers against astronomical debt evaporated. Victory proved that a nation could spend multiples of its revenue without immediate collapse. The addiction was now structural, woven into the fabric of governance itself. But there was always one constraint, one enforced sobriety that limited how far the addiction could progress. Before 1971, every dollar was theoretically backed by gold reserves at Fort Knox. This created a hard limit on money creation. You couldn't print beyond your gold supply without risking a run on the currency. Then, Vietnam War costs and Great Society programs strained the system beyond sustainability. Foreign governments, watching America's gold reserves drain, started demanding actual gold for their paper dollars. President Nixon faced a choice: admit insolvency or remove the constraint. On August 15, 1971, he severed the dollar's link to gold. Overnight, the last external limit disappeared. The dollar became what economists politely call a fiat currency, money backed purely by faith. In addiction terms, Nixon removed the last guardian. America could now self-medicate without restriction, creating as much currency as needed to feed its spending habit. Here's how the modern self-supply mechanism actually works, and why it represents the deepest stage of dependency. The Treasury Department issues bonds to cover spending gaps between revenue and obligations. In a healthy system, private investors and foreign governments compete to buy these bonds. But when appetite weakens or needs exceed natural demand, something remarkable happens. The Federal Reserve, America's central bank, manufactures purchasing power electronically and buys Treasury securities directly. This isn't a backup plan anymore. It's standard operating procedure. During the 2008 financial meltdown, the Fed purchased over $1 trillion in Treasury securities. During the 2020 pandemic response, that figure exploded past $4 trillion. The process is technically complex, involving bank reserves and balance sheet expansion, but the effect is simple. America no longer needs external approval to finance its addiction. It supplies itself. The dealer and the addict are the same entity, and the doses are measured in trillions. So who benefits from this self-supply system? And who absorbs the damage? The answer reveals why this addiction is so difficult to break. The political class benefits enormously. Politicians can promise expanded programs and services without the political pain of raising taxes. They can deliver immediate gratification while deferring the withdrawal symptoms to future administrations. This creates powerful incentives to maintain the addiction, regardless of party. The financial sector benefits perhaps most dramatically. When the Federal Reserve floods the system with newly created money to purchase Treasury securities, that liquidity doesn't stay contained. It cascades into financial markets, propping up stock prices, inflating real estate values, and enabling risk-taking that would be impossible in a constrained environment. Banks and investment firms thrive on this artificial abundance, but regular citizens experience the side effects with brutal clarity. Every debt monetization episode dilutes the purchasing power of existing currency, an invisible tax that strikes savers and wage earners hardest. Your salary might remain steady, but the grocery bill climbs relentlessly. The house your parents could afford on a single income now requires 2 incomes and massive debt. Retirement accounts grow in nominal terms while buying less actual goods and services. This isn't accidental inflation. It's the inevitable consequence of currency creation exceeding economic growth. The international dimension adds another layer of dependency. For decades, foreign governments, particularly China and Japan, acted as enablers of America's addiction. They accumulated massive treasury holdings, financing U.S. deficits while maintaining their own economic strategies. But watch what's happening now. Foreign central banks are reducing their treasury positions. China's holdings have dropped from over $1 trillion to under $800 billion. Japan's appetite has cooled. These former enablers are backing away, recognizing the addiction spiral. This forces America into even greater self-reliance. As external demand weakens, the Federal Reserve must intensify its own purchases. The dependency deepens precisely as outside support diminishes. It's the classic addiction spiral. When traditional sources cut you off, you find more dangerous ways to supply yourself. History offers chilling precedents of what happens when nations become addicted to debt financing they control. The Spanish Empire in the 16th century discovered massive silver deposits in the Americas. This wealth enabled deficit spending on a scale previously impossible. Massive military campaigns, lavish courts, sprawling bureaucracies. Spanish kings borrowed freely against future silver shipments. But colonial sources eventually dried up. Competitors challenged Spanish dominance, and the cost of empire exceeded even silver mountains. The empire declared bankruptcy multiple times, each default making the next borrowing round more desperate and expensive. The addiction that seemed sustainable during abundance became unbearable during scarcity. The British Empire followed a similar arc. Victorian Britain financed global dominance through sophisticated debt markets, backing massive infrastructure and military spending with the pound sterling's unquestioned status. This worked magnificently, while Britain controlled world trade routes and industrial production. But 2 world wars shattered that advantage. The debt accumulated during dominance became an impossible burden once competitors emerged. Britain spent decades unwinding obligations, accepting diminished status as the price of its prior addiction. The lesson repeated. Reserve currency status enables the addiction, but dependency deepens precisely when the advantage proves temporary. Perhaps most ominously, French monarchy's addiction to debt financing triggered revolution. Successive kings borrowed to maintain appearances, elaborate courts, expensive wars, administrative bloat. Each borrowing round made the next necessary because obligations compounded faster than revenues. When lenders finally lost confidence, the entire structure collapsed not gradually but catastrophically. The pattern across empires is identical. Early success with deficit financing creates dependency. Dependency deepens during good times. And when advantages disappear, the withdrawal symptoms prove devastating. Watch for the modern warning signals. BRICS nations actively discuss alternatives to dollar-denominated trade. Central banks worldwide are accumulating gold at rates not seen in decades. Foreign appetite for Treasury securities continues weakening despite higher interest rates. These aren't random events. They're signs that global enablers recognize America's addiction trajectory and are preparing exit strategies. But abstract economic trends don't capture what this actually means for you personally. Every time the Federal Reserve creates currency to purchase Treasury securities, It dilutes the value of every dollar you hold. This isn't theoretical. It's theft through mathematics. Consider housing. The median American home that cost $30,000 in 1970 now exceeds $400,000. Did homes improve 15 times in quality? No. The currency depreciated because continuous money creation to feed government spending flooded more dollars into limited assets. Your groceries tell the same story. Beef that cost 98 cents per pound in 1970 now exceeds $8. Again, the product didn't change. The measurement unit did. The retirement crisis illustrates this perfectly. Previous generations could save modest amounts in simple bank accounts and maintain purchasing power. Today, inflation erodes savings faster than interest accumulates, forcing everyone into risky investments just to stand still. This isn't natural economic evolution. It's the side effect of systematic currency dilution to support government addiction. History provides stark warnings about where currency creation spirals lead. Weimar Germany in the early 1920s showed what happens when self-supply accelerates out of control. The German government, facing impossible war reparations and political instability, printed currency to meet obligations. As money supply exploded, citizens famously needed wheelbarrows of cash to buy bread. Life savings evaporated. The middle class was economically annihilated. The social chaos that followed created conditions for extremism. Even America's 1970s stagflation, though far milder, demonstrated that reserve currency status doesn't provide immunity. Despite the dollar's global dominance, persistent inflation combined with stagnation showed that monetary manipulation carries real costs. Currently, warning signals are flashing everywhere. Inflation persists, despite aggressive interest rate increases, suggesting underlying structural problems beyond normal business cycles. Asset bubbles appear across real estate, stocks, and cryptocurrencies, classic symptoms of too much money chasing limited investments. Wealth concentration accelerates as those closest to the money spigot capture gains before dilution spreads. Perhaps most concerning, Treasury auctions occasionally struggle to attract sufficient demand at acceptable rates, forcing larger Federal Reserve interventions. Here's the fragility nobody discusses publicly. This entire system depends on maintaining confidence in Treasury securities as safe stores of value. If that confidence fractures, if enough investors conclude that American debt represents not stability but addiction, the feedback loop accelerates catastrophically. Declining demand forces more Federal Reserve purchases. More purchases mean more currency creation. More currency creation accelerates inflation. Rising inflation further undermines confidence in Treasury instruments. The spiral feeds itself, and unlike government institutions, you personally will absorb the withdrawal symptoms. Your savings, your wages, your retirement, all measured in a currency whose purchasing power depends on maintaining an unsustainable addiction. Every debt addiction in history eventually required detoxification or ended in collapse. There are no exceptions to this pattern. America possesses one advantage that delayed consequences. Reserve currency status means the world still needs dollars for international trade. But this advantage intensifies eventual impact rather than preventing it. The deeper the dependency grows during the delay period, the more violent the adjustment when reality intrudes. And make no mistake, the addiction has become structural. Neither political faction can significantly reduce deficit spending without triggering economic withdrawal symptoms that would be politically fatal. Democrats want social spending. Republicans want military spending and tax cuts. Both require continued borrowing. The addiction transcends politics because it's now essential to maintaining the system both parties inhabit. You face a choice that earlier generations didn't. You can remain an unaware victim, watching your purchasing power erode while wondering why everything feels more expensive and precarious. Or you can understand this system deeply enough to position yourself strategically for what's coming. Knowledge won't stop the addiction cycle, but it might protect you from the worst consequences. Subscribe to continue accessing analysis that cuts through official narratives and reveals the patterns those in power hope you won't recognize. History's verdict is clear. Addictions don't resolve themselves gracefully. They either get treated through painful but necessary intervention, or they consume the addict completely. America's government shows no signs of choosing treatment. The doses keep increasing, the side effects keep intensifying. And the moment when the system demands withdrawal draws closer with each trillion added to the debt. The question isn't whether consequences arrive. The question is whether you'll see them coming.